We're news for business people.
Hello and welcome. You're watching Bloomberg Quint Live, India's first digital live streaming business news service. And this is Trend Spotting. I'm Navneet Saluja D'Souza.
Hi, I'm Agam Akil. And in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and its implications for investors. But first, the headlines. Indian markets open low as investors take a closer look at corporate earnings and the government's decision to forego 22,000 crores after reducing taxes of as much as 211 items. And losses widened for Idea Cellular in Q2. However, the telecom major announces the sale of its tower arm to American Tower Company for its 4,000 crores. And Larsen & Toubro falls more than 2.5% in trade after capital goods major cuts to new order guidance in the rest of the year. And finally, in the markets to watch for September quarter earnings as far as Adani Ports and NTPC, which are likely to report earnings today. And it's a tepid listing for New India Assurance, the country's largest general insurance, debuts on the discount on the bourses.
And on Trend Spotting today, we first put the spotlight on what is making Dewan Housing Finance buck the trend among its peers as we connect with the management and decode the factors making the counter rise in the not only last 3 months, actually, also on YTD basis. We also discuss the rise in petcoke prices and its impact on the cement sector as we connect with Murtuza Arsiwala of Kotak Institutional Equities. And lastly, we shift focus to the GST rate cut on restaurants and impact of no input tax credit benefit as we connect with Rajesh Kumar Mota of Speciality Restaurants.
Well, there you have it, guys. Let's move across to the first trend. And this is Dewan Housing Finance. And the stocks gained over 50% in the last 3 months. And this is actually bucking the trend because if you notice, the rest of the players in this particular segment or the area have either lost out or seen marginal gains. And that said, the likes of LIC Housing Finance, GIC Housing Finance, Repco Home Finance, or for that matter, Canfin Homes, have seen a lot of weakness in the last 3 months, whereas Dewan Housing Finance is the only counter which has not only gained, but gained substantially. If we can pull up the analyst ratings on Dewan Housing Finance as well, according to Bloomberg consensus, you'll notice that 80% of the analysts on the Bloomberg consensus have a buy rating on the counter, with the remaining 20% have a hold. So if you can see there are no analysts, or at least on the Bloomberg consensus, which have a sell rating on Dewan Housing Finance. But, to take this matter forward and to understand what's going on, not only the sector, but with the company itself, we're in conversation with the Joint Managing Director and Chief Executive Officer of the company, Harshil Mehta. Hi, Mr. Mehta. Thanks for joining us. And my first question will have to do with where the majority of your revenues are coming from, and that's housing finance, of course. My question there was, especially in the Tier 2 and Tier 3 cities, where there is a lot of competition, what is Dewan Housing Finance doing to differentiate themselves, and where are these advantages coming in from?
Yes, good morning. Now, coming specifically to your question with respect to what kind of differentiates DHFL from the others in the Tier 2 and Tier 3 markets, I think we need to go back to the very genesis of the foundation of this organization, which has been focused around the low and middle income segment, and in that continues even today after 33 years of our operations. It is predominantly to do with the products which are aligned to the requirements of the customers in those cities, predominantly coming in from a particular segment. And I think that is what is driving the growth, which also has a very strong tailwinds coming in because of the government's push on affordable housing. So some of the areas is with respect to how we are able to have products which are in line with the requirements, whether it is to do on the basis of the cash flow analysis, whether it is to do with the industry where they are working, or the local geo-economic activities in those locations. which kind of align where our products meet with that.
Mr. Mehta, good morning to you and thanks a lot for joining us. And first of all, congratulations and good set of numbers for the September quarter. Your stock price has been doing pretty well, so I'm just assuming the shareholders are pretty happy with the kind of performance the company is putting up. I was reading a lot of reports and majority of the analysts are of the view that it's a good play on affordable housing. Now, this is one company which has pan-India presence and you also cater to lower middle class income with the average loan value of almost between 14 to 15 lakh. I just want to check what's the ground situation with regard to affordable housing right now. Are you getting a lot of inquiries? Are you sanctioning a lot of loans which are attributed to that sector?
Yes, when we specifically look at affordable housing, and especially when you look at tier 2 and tier 3 markets, for the benefit of your viewers, I will just give this update. We just concluded what we call as a property exhibition, where you have developers in a location like Chandanpur in West Bengal. And I got an update that we had to extend the timings, till about 10:30, 11 o'clock in the night, because you had so many people walking in, looking at all the affordable housing projects which were available and applying for spot sanctions. Now, this is what is happening in the tier 2 and tier 3 markets at the local level and the ground, with the PMAY subsidy, which is close to 2.4, 2.5 lakh rupees, and add to it the fact that the interest rates are also low, with combination of both the things, you are actually seeing a lot of interest with respect to affordable housing, and people are willing to go and take that call, and we are seeing this happening across the country.
Mr. Mehta, what we also noticed is that there's a good growth coming in for your loan against property segment. And this is at a time when a lot of your peers are reducing exposure to this area. So if you can also take us through what's happening as far as this segment is concerned, and whether or not we can eventually see relatively more contribution of revenues also coming in from this area.
Yes. See, firstly, predominantly, I would like to also use this opportunity to clarify that loan against property SME overall from a portfolio perspective is just about 20%. We are predominantly affordable housing, individual retail home loan provider, and going forward, the ratios are pretty much going to be the same, home loans being the 2/3. While what you are seeing with respect to the growth on LAP and our SME book is predominantly on a lower base. However, at the same time, we have also seen a lot of interest coming in from typically your traders, merchants, and wholesalers in the outskirts or within the metros as well, as they transition their business more towards being GST compliance. And we saw that good opportunity coming in, which is backed by a residential property. I would say more than 85–90% of our loan against property, the mortgage is backed by self-occupied residential property. So, to clarify your question is that, we do not have to reduce because we don't anyway have a large base of loan against property. It is anyway on a smaller base, and overall from a portfolio perspective, it is 20%, but it is a very critical and a segmented approach from a diversification perspective on our portfolio. It also supports us with respect to the yields and the fees. So we clearly see an opportunity over there to go and pick on the right client and the right credit onto our books.
Mr. Mehta, I was just coming to the yields question, but before that, just want to know, do you see that 20% figure going up in the coming quarters, or let's say in the next 2 to 3 financial years?
Yes. See, we need to look at loan against property and SME holistically, from not necessarily from a quarter-on-quarter, but we need to look at sequentially from a year-on-year perspective, because on a quarterly basis there could be ups and downs. But what is the trend? And if you look at the trend very clearly, we are saying that our home loans portfolio will continue to play a very significant large portion of our entire portfolio, which is more than 2/3, and that's how you would also see it going forward, predominantly driven by home loans in the affordable housing segment. Loan against property SME will continue to remain around 20%. Our project finance will be around 12%, 13%.
Okay. What's the impact on yields for your loan against property segment and also for home loans with the PSU bank recapitalization now coming about?
Yeah, so much has been talked about recapitalization, so we would like to give our comments with respect to that. See, overall we see that recapitalization is definitely going to boost credit offtake, and I think that is the intent as well of the government behind recapitalization. Now, if we do a further waterfall on that, it is something which is going to happen over a period of 2 years. Further down, it is focused predominantly around MSME sectors and that 50 clusters. So when you look at that, clearly it means two aspects. One, it broad bases across the country the awareness with respect to retail credit offtake. One of the biggest factor which goes in favor of housing is our single-digit mortgage GDP ratio. So even if we were to look at our Southeast Asian peers and neighbors, we still have a long way to go. Even if we were to double this from here, you will still need a plethora of formal credit lending institutions to meet that requirement. So we clearly see this as another area of opportunity opening up by virtue of just because the market becomes broad-based. And with our target segment, with our focus in the tier 2, 3 market, we clearly see this as an area of opportunity either for direct lending or as a securitization of our portfolio, because these banks always need, portfolios are always hungry for portfolio to boost their lending.
Right.
So you clearly see this bank recapitalization coming in as a big growth.
Okay, but talking about opportunities, as you mentioned, are there any opportunities with regard to cross-selling any financial products to your customers, be it in the insurance space or the investment products?
See, today customer, is offered various options, and predominantly from a perspective to see how it augments, and it kind of supplements their own loans, whether it is to do with respect to protecting the asset, so that in an uneventful situation, their loan is covered and they really do not have to face with any unpleasant situation. So they have all those options available with them, because in this segment, what you also get going is the fact that it brings in financial awareness, and also to a certain extent it starts building up the awareness of towards savings for self and family for future.
Okay, Mr. Mehta, thank you for joining us and taking us through the current trends in affordable housing finance, and also perhaps giving us your outlook when it comes to Diwan Housing Finance specifically. But we move on to our second trend of the day, and this has to do with pet coke prices, which have risen to quite an extent, and they've also had quite an impact when it comes to quarterly earnings for at least some of the companies in the cement space. But to give us more details, let's go across to Nikki Merchandani, who joins us and who will be telling us a little more about how this affects the players in the markets. Nikki?
Sure. So we have seen this input price pressure playing out on the companies, the operating performance of the companies, particularly that coming in from pet coke. We also saw some rise in freight costs, along with some sand mining issues for the industry as a whole. But then addressing the first issue, which is the pet coke issue, which is almost a key ingredient that goes behind the making of your power and fuel expenses that form around 20-25% of your overall operating expenses, or your net sales eats into your 20-25% of your net sales. So if you're supposed to look at that, if you look at the trend that we've seen from November 2016 to November 2017, now the prices have shot up to $105 per ton, which is almost 19% higher as compared to year-on-year basis. If you look at the quarterly trend for the quarter ended September, the prices are shot up as much as 22%. Now UBS says that the disruption in US production in the recent months, that is due to the Hurricane Harvey, that have led to the recent hike in the prices of pet coke. Now, also there is one more issue which is playing out for this key raw material, which is also a highly polluting fuel factor, where we have seen the recent ban coming in on the use of pet coke as directed by the Supreme Court and is limited to NCR or Delhi regions. But then the fear is that if this goes through in some of the regions, other states might also go through it, and if this is implemented further, which means that the companies may have to resort to alternative fuel strategies, which in turn could escalate their cost. In terms of other concerns, as I just mentioned, we have seen the industry being plagued with the sand mining issues along with the higher freight costs, which have impacted their operating performance. Now, if you look at the chart that we've seen for EBITDA per ton for India Cements, Dalmia, Shree Cement, JK Cement, and all the other pan-India players, be it ACC, Ultra or Ambuja, you will see sequentially these prices, the EBITDA per ton for these companies have come down, and particularly you would see the trend pretty evident for pan-India players. If I'm supposed to assess the impact of pet coke prices given the firming trend and the SC ban which would come in, I believe that Shree Cement would be a major hint there, because that's 100%. It uses pet coke as 100% of its overall power and fuel cost. We have a chart here which helps us understand what are the usages of pet coke for each and every cement company as a percent to your overall power and fuel expenses. If you look at the chart, you see Ambuja Cement, which is almost at 62%, and you would see witness a high usage of pet coke coming in from Mangalam Cement as well as your Shree Cement. Now, Mangalam Cement almost uses 96% of pet coke in the overall power and fuel cost for that matter, Agam.
So clearly, the pet coke prices have been rising, and that chart showed you that from the month of February, when it at $78 per ton, to now the pet coke prices are currently quoting at about $105 per ton. But let's get a better perspective from an analyst who tracks this sector pretty closely, Murtuza Arsiwala, Head Senior Analyst at Kotak Institutional Equities, who is joining us. Hi, Murtuza. Good morning. Thanks a lot for joining us. Well, Nikki, who tracks this sector pretty closely, just highlighted that how the rising pet coke prices have increased the cost pressures on companies who have used this alternative power usage from coal to pet coke now. I just want to understand, do you see this trend going in the second half? Because she also mentioned that still there is that gap between the coal prices and pet coke, which are still cheaper to coal. Do you see that gap bridging in the coming quarters?
So it depends how, there were obviously temporary disruptions in the U.S. because of which pet coke prices rose. Let's see if they moderate going forward or stay firm where they are right now. That's one part. Currently, there is still about a 10-15% differential between pet coke and imported coal. Again, it depends as to where your plant location is, and in certain cases you may just find it worth your while to sort of shift to imported coal. In terms of the cost side, yes, we do see this actually, because what you saw in the quarterly results gone by was still companies using low-cost inventories. So, the current price trends where you talked about pet coke prices having moved to 105, that is still to reflect in the income statements of companies, and to that extent, there is definitely cost pressures in the coming quarters.
Okay, so Murtuza, how would you place the regional players as against, pan-India players when it comes to these issues?
In terms of the cost issues,
yes.
Clearly, traditionally,
yes.
the north-based players were more dependent on pet coke. So they are the ones which are going to see, a larger sort of hit in terms of the higher pet coke prices. Also, accessibility to both imported coal or domestic coal, just because of the location, makes it that much tougher for them to shift, which is why they want pet coke in the first place. So clearly, the north-based players will bear a higher brunt of the rise in pet coke prices versus, let's say, the pan-India players. Again, I'm not so sure how much of an impact the immediate, sort of restriction on usage will have, given that it's restricted to NCR and surrounding regions, wherein a lot of the plants of some of the players are not coming within that NCR region. So, they're not subjected to the ban or restricted usage on pet coke just yet.
Hi Mrituza, this is Nikki here. I just wanted to touch base upon an important issue that we're looking. We just mentioned about it, the ban on the pet coke, which few cities has been imposed on few cities, and the other cities too might follow suit. If that comes through, Mrituza, I'd like to understand: can we expect cost pressures to escalate from here on, given that the companies will now be rushing to the alternate source of strategy for fueling, or how is it otherwise?
So let's put it, if we take petcoke prices, imported coal, etc., where they are today, if there is, let's say, a scenario, a hypothetical scenario that petcoke usage is banned across regions, you definitely see an increase on the power and fuel cost. That would be of the order of 10 to 15%, given that imported coal prices have also been rising, and the differential has narrowed down compared to, let's say, 6 months or 9 months ago. The differential between imported coal and petcoke has narrowed down, and therefore the ban will be sort of less punitive in that extent, but still you will see an additional 10 to 15% increase in cost.
All right, Mrituza, the other question that I have for you is about the sand mining issues. Now, we did see some shortage thereon, and that impacted to a certain extent on the cement companies for this quarter. We also saw the RERA negatively impacting the constructive activity in the west, with southern states like Tamil Nadu and Kerala also being impacted. I'd like to understand, where do we stand in terms of these issues? Are these issues behind us?
So again, not as much clarity on them because they're state-specific issues. But if one were to go by management commentary, Bihar, which was one of the states which was more affected, seems to be on the verge of resolving it. Tamil Nadu was another state which was much more affected, and clarity not fully there in terms of the resolution out there. So it is an issue that has bogged down sort of cement consumption over the last 6-9 months. Hopefully we'll see the tail end of the issue though.
All right, Mrituza, the final question that I have for you is, at this time, what do you think? Which stock looks an attractive bet given the kind of lofty valuations we're seeing for the industry?
So our way of looking at it has been that a lot of the cement players have been at lofty valuations. Therefore, instead of Ultratech, we've preferred to play it through the holding company, which is Grasim Industries. Another one that we've so far been positive on, and the stock's done fantastically well, is Dalmia Bharat. So these two are on our positive list. A lot of the others, because of where valuations are and the earnings sort of falling short of expectations, we have not been as positive on.
All right, Mrituza, before I let you go, just want to check, what does your channel check suggest? The companies who were using pet coke, are they looking to switch back to coal or not?
Not yet.
All right. Thanks a lot for joining us today and giving us your views on what it exactly means for the cement companies with the rising petcoke prices. Also, the ban which is there in the NCR region, there is a fear that it could get escalated to other states from the likes of Haryana, Rajasthan or Uttar Pradesh. And if that comes about, these companies who've been using petcoke, they will have to shift back to coal, which means more capex for them. So let's see how that pans out. Clearly, the September quarter earnings reflected rising cost for them. Let's move on to our next trend. The GST Council has cut tax rates on 211 items across all tax slabs in an effort to rationalize rates. One of the sectors that is seeing some relief from the GST tax rate revision is the restaurant space. GST tax rate has been revised to 5% from 18 and 12% earlier. But the restaurants will not get any sort of input tax credit. What does this mean for the industry then? Let's ask Rajesh Kumar Mota of Speciality Restaurants, who joins us on the phone line, and Saloni Dhanuka too joins us. Saloni, over to you.
Good morning, sir. So my first question to you is, GST Council has slashed rates from 18% to 5% now. So what kind of impact will it have on specialty restaurants in particular?
The government has done a great move by reducing the GST rates from 18 to 5, because this is most welcome, as it is because of this reduction there would be enough money left with the guest for spending. So this is definitely a great move and would help increase spends by the guests.
And also, sir, what about the input tax credit? How will it be impacted?
This is where we have been affected, because input tax credit has been withdrawn with this reduction. So we are analyzing as to its impact, because in any which ways the input credit used to be in the range of almost like 6 to 7%. So we are reworking, because there are certain items which have been lowered from a tax point of view. And we are trying to analyze and see how we can mitigate this so that the margins remain intact.
How are you planning to control prices? Will there be a price hike on the menu or to offset the input tax credit benefit?
It would be too early to say exactly there would be a price hike. Yes, say for instance, if we are left off with increased costs at our end, the only way to neutralize is price increase, because we are very cautious in increasing prices primarily because we would like footfalls to increase, and we would have to work out strategies so that if it gets compensated, if not, we will have to.
So because you talked about footfalls, what does this do for footfalls overall? Will there be a substantial increase, or how is it going ahead?
See, what happens is that the moment there is a reduction in the taxation and people are left with more money to spend, in all probability, and that's what the GST Council would have also thought of, that this would lead to increased spend by the guests, which in turn would lead to increased footfalls and more spending by the guests who are already coming in.
And so my last question to you is, how will this pan out for your different formats, say for mainland China and for Hoppy Pola in particular?
See, Hoppy Pola has majority of the sales in form of liquor, where there is no impact because GST is not applicable on liquor. But as far as food restaurants are concerned, yes, it's a great move, subject to that input tax credit withdrawal.
All right, sir. It was pleasure speaking to you. Thank you so much for talking to us. So that was the management of Specialty Restaurants. Back to you guys in the studio.
Okay, thanks for that, Saloni. But we're going to move on to the other important development of the day. Idea Cellular and Vodafone India have decided to sell their individual tower businesses to American Tower Company. What's interesting is that the Idea will get a higher value than Vodafone despite having a lesser number of towers. Somit Sarkar is here to tell us why. Somit, what's the rationale behind this?
The reason behind why Idea will be getting more money is because of the tenancy ratio. The tower that Idea owns, the tenancy ratio of those towers is close to 1.8 times, while that of Vodafone is 1.5 times. Now, Vodafone has around 10,235 towers, while the tenants on those towers are around 15,557. So the tenancy ratio comes to around 1.5, and while that of Idea Cellular is 10,000 towers with a tenants of around 17,914, which comes to around 1.8 times. So that's the reason why Idea will be getting more money. Now, Idea will be getting around 4,000 crores, while Vodafone will be getting 3,850 crore rupees for this deal. And the proceeds of this deal will be used to reduce the debt of the merged entity. Now, what ATC will get out of this deal is, ATC owns around 13% market share in the tower industry, and with this post completion of this deal, that ATC's market share will be boosted by around 6 to 8%. Also, according to ATC's media release, this tower assets will add around 2,100 crore rupees to its revenue, and the gross margins would be around 800 crore rupees, while the other expenses, which are selling, general and administrative expenses, would be less than around 100 crore rupees, which means the EBITDA of the company would be EBITDA of these towers would be close to 700 crore rupees, which means a margin of around 33.33%. This is what ATC gets out of this deal.
All right, Somit, thanks a lot for joining us and taking us through those details. Well, with that, it's a wrap on this edition of Trend Spotting. Thanks a lot for watching the show, but don't go anywhere. Up next is Hot Money. Stay tuned.